Hello, everyone, and welcome to second episode of a new series we're trying out called Chat with Pros. Where we're bringing the best minds of FinTuit and the trading community, and we're having an honest, candid conversation. I'm personally really excited about our guest this time around. His name is Dennis Dick. He's a fellow chartered financial analyst. He's been in the industry for over 20 years. He's now a co-host of the Morning Prep Show with Ben Zinga, as well as the PreMarket Prep Show. And he's been on fire recently with his amazing calls on the market. If you don't follow him on Twitter, make sure to do so. Dennis, welcome to the show.
Hi, Artie. Thanks for having me.
Yeah, we are absolutely excited to have you. Majority of our community actually know you and follow you, but for those who don't, could you give us the quick elevator pitch about your background? I know you probably get asked this all the time, but
Yeah, oh gosh. Okay, so I started trading retail back in 1996. Traded retail with my family's money there for about 2 to 3 years, and then in 1999, when I graduated from the University of Windsor, I joined proprietary trading firm Bright Trading in their Detroit office, and I traded there for a good 15 years. So I was with Bright in their office for a long, long time, trading with the prop firm, and I continued to trade with Bright Trading up until last year, just remote, so from my home. So I left the Detroit office back, I think it was 2013, and traded from home for about 8, 9 years, and then just last year I've left Bright Trading, and I've actually just trading for my own firm now, which is Triple D Trading.
yeah, that's amazing. Just kind of speaking of that, because you've seen the dot-com bubble, and then you've seen the '08 crash, and now
Yeah.
we're in this new bear market. In terms of like market regimes and how it has changed, and kind of defining your edge in every different market regime, can you walk us through how is trading right now different than it was maybe 15 years ago, 20 years ago, and how is this bear market different?
I mean, trading overall has changed dramatically. When I started back in 1999 with Bright, there wasn't as much algorithmic action. Most of your orders went directly to the floor, so you're interacting with the specialist on the floor. I think it was like 92% of the volume back on the NYSE stocks was done through the actual NYSE. So you had basically, and we had the direct connection there. So it was a nice edge that we had with Bright Trading to be able to send our orders directly to the specialist. They interact with them, send us our confirmations back. When I started in 1999, it was funny. On NASDAQ, you'd get instantaneous fills, but on New York, because the human involvement was still there, it was still 8 seconds to get your confirmation back. So if I sent an order to the NYSE floor, they had 8 seconds to give me the confirm back, even if I was lifting the offer. So like just taking the offer, I basically,
Yeah.
that order goes to the floor, yes, and then they tap the screen and send the order confirmation back to me. Within a couple of years, it got down to 6 seconds. And then obviously over the years, automation has happened. Reg NMS has happened. Market structure has changed. We know market fragmentation has changed the markets as well. So now we obviously get instantaneous execution. So just, from the dynamics of, market structure, how much it has changed. Obviously, our strategies have changed as well. I did a lot of market making in the early 2000s. I did electronic market making as well, where I had a separate account running just automated strategies, which did very well. And it's funny, and after 2010, 2011, it became very hard to compete with the other high frequency traders like Citadel, Virtue, Two Sigma, all the big guns. So I've kind of went back to full discretionary trading. So I've went full circle with my overall strategies. So that's, the market structure aspect of it. And then you're asking, how is this bear market different from the bear markets back in 2000 or 2008? This one isn't as violent. I mean, we're not seeing the VIX, right now we're with a VIX of 20. I mean, back in 2008, actually in 2020, it got pretty crazy too with COVID, but that didn't last very long. But 2008, we saw the VIX spiking 40, 50, 60 in some cases. The dot-com boost, bursting, and then 2008, the financial crisis, obviously elevated. So I would say a lot calmer. And some people would argue we're not even in a bear market anymore because we've kind of been up since October. So,
Yeah.
if we really look at the October lows, we've kind of had this mini bull market, maybe in this overall bear market. But this one's a lot calmer than, say, 2000 or 2008. And I don't think we're going into financial crisis part two.
So this is very interesting because mentioning about comma, and I just tweeted about this comparing move, which is the volatility of the rates in the bond market and VIX, and I think it was the Odd Lot podcast. They had a strategist from Numera, and he was arguing the reason VIX is not as spiking is positioning. The fact that a lot of people are on cash or underweight equities, so they
Yeah.
don't really need crashy protection, or they're mostly either cash or at the money puts, and you can kind of see it from the skew, closer to 120, 130. Are you seeing the same thing as well, or?
There could be an argument there that obviously, a lot of people have seen this one coming. I mean, back to 2007, 2008, and a lot of people know how to protect their portfolios
Yeah,
probably better today than they did maybe in 2007, 2008. There's more products out there. There's a lot of options, that come into play, like in talking to weekly options to like daily options. I mean, the structure has changed so much. So there's definitely an argument there, but we're just not in, let's just take all that out and just, if we compare it apples to apples, there's just, we're not in the financial crisis. We already have
yeah,
banks failing left and right. We don't have Bear Stearns going from $80 to $2 or Lehman Brothers going to zero. I mean, it's one thing to lose a couple of small regional banks. These were major banks we were losing back in the
yeah,
financial crisis. And obviously, they came together, the Fed, and threw more money at the problem to try to obviously calm, and it worked. But I mean, we're just not even, remotely into that environment. And then the 2000 tech bubble burst was just a valuation thing. I mean, stocks were trading at ridiculous multiples. Cisco was trading 80 times earnings. Walmart was trading 45 times earnings. I mean, the valuations were just nuts back in 2000. So that was just a valuation bubble popping, is what that
yeah,
was back to 2000. Here, valuations are elevated, but they're not ridiculous. I mean, I think we're trading 19 times, 19, 20 times earnings here on the
yeah.
S&P. So it's not crazy. So you don't have that valuation coming out of it. But obviously, people are concerned about the whole bank crisis. I'm concerned about the regional bank situation as well. I have a lot of cash, protecting that to a certain extent, but also just ready to put and deploy some of that cash if circumstances change.
Yeah, this is very interesting because I think, speaking of valuation, I think in 1996, so before the dot-com craziness, I think Alan Greenspan came in and said valuations are getting a little irrational in
Yeah.
1996. So he was a little too early. And just prepping for this interview, I was listening to your previous podcast, and you were saying one of the problems or downfall with your trading is that sometimes you're too early in the
Yeah.
calls. How do you deal with that? Being early in a call.
I'm always too early. It's better to be too early than too late, though, I always say.
True.
So I'll take you to, a classic example that I talk about on the pre-market prep show with Benzinga as well. So let's go to the COVID crisis back to 2020. And
Yeah.
you could see this coming. I mean, we saw what was happening in social media. And the one thing about social media is word spreads so fast. So things
So
have
fast.
changed. Information flow from social media is incredible. So you can get information. Sometimes it can skew your perception to a certain extent. So you got to be careful what you're taking in. But it was fairly obvious come December, January of 2020 that this COVID thing was coming to North America. And I know we had people saying, oh, it's contained. We only had 12 cases, but you could see the way it was spreading over in China,
Yeah.
that it was probably going to start to spread over here as well. So it was kind of common sense. So I really was bearish the markets in January 2020. I sold a majority of my long-term stock portfolio, and I bought puts on the rest of it to hedge the entire thing. And then I also bought puts on airlines. I had puts on a whole pile of stuff. This is in January. I'd say around like January 15th, the middle of January. And I was just
Yeah.
talking with Joel and saying, this is coming. This is going to be ugly, and the market's going to get really hard on this. And we were talking, you can go back to listen to the pre-market prep shows in January 2020 as well. And we kept preaching, that there are some tough times coming for this market. And protection was so cheap because the market really didn't price any of it in. So I can remember buying, SPY puts and paying maybe, less than 1% to go out a month for protection. So I bought
Mm.
all these puts, and most of them were expiring at either, I think it was the end of or the third Friday in February. So when
Right.
that I was too early on this trade. So
Yeah.
I had all these puts, and I bought them because I figured, 1 month out, this is going to be really spreading and the market's going to get hit. So it comes to the middle of February. I'm like, are you kidding me? I'm like, it's starting to spread. The markets are still sticking up at all-time highs. I'm like, this is crazy. So I'm like, I'm right, but my timing is way off here. So all of those puts that I bought expired worthless, or I had to roll them. So what I did
Yeah.
was, I'm like, holy, I'm like, I put out all this premium to protect my capital, and here's the stock market a month and a half later, still trading at all-time highs mid-February or near it. And I've got all these puts for protection, all going to expire third Friday in February. And I'm like, I didn't go out far enough. So the next roll, so what I did was, obviously those expired all worthless, and I lost on those puts, which sucks to be that early. Be right on the call because you know what's coming in March of 2020, and have all
Yeah.
those puts expire worthless. So I was like, screw it, I'm going out to June this time. So I was still convicted with my call. I just knew I was too early. So I went out to June, bought puts on SPY, bought puts on a number of different other things. I was still had a whole pile of cash because I'd sold a lot of my stocks, and I'm like, this, I'm going to be right here eventually. And then finally, obviously, in the middle of March, the stock market started to collapse. We got the lockdowns, the spread, and I believe in March, I believe the S&P fell almost 30% that month,
Yeah.
which would be one of its biggest months fall in one month ever. So all of my puts protected my long-term portfolio. I had my best trading month in over a decade because I was leaning short because I was so bearish the market. So it ended up working out, but again, I was so early back in January. I was 2 months early on that call, and it was a very good call, but just being so early. So, but I was convicted enough to put the trade back on, even though obviously the market was telling me that I was wrong. But all that was already just going back is information flow. You're not looking at technicals. You're not looking. I'm looking at social media, and I'm seeing this virus spread and saying, hey, there's going to be government intervention here eventually. We're going to have some issues. I didn't know the full lockdowns and stuff were coming, but they obviously did, and that's when the S&P really collapsed.
That's amazing. So, it's so interesting being early. I have a trade on right now, and I've been putting it on Twitter, and I feel like I'm early, but this trade will work out. Long some TLT calls, long
Okay.
dated.
Yeah.
I think so. The duration of TLT is about 17 years. I think the rate should be somewhere around 2.5%. They're at 3.5%. So, do a quick back of math calculation, back of the envelope calculation. TLT should finish the year around 120. A 17% rally. So I've been selling puts and I've been buying long dated call with the proceed. It hasn't been working out yet, and I feel like I'm early, but I feel like the recession is coming. Rates need to steepen, the yield curve, and TLT should rally. Can I get an expert opinion on this trade? Do you think it will
I
work
think
out?
you're going to be right too, and I think you're early as well. Like my opinion is that we're going to get more bank failures. I think the S&P is just in a choppy zone right now. We're March 28th here right now. I think the S&P is just chopping around. Kind of, you have the bulls and the bears. The bulls saying, yeah, this, we're going to get past this banking crisis, and the new bull market will form after this, and tech stocks will lead the way. The bearish argument is there's more bank failures to come, more regional bank failures. And I think that's what the market is still pricing a little bit of that in. You can see it when you look at a stock like FRC, which is still trading at $12 here today from $120 2.5 weeks ago. Stock is down 90% for a reason. That's probably because eventually there may be some government intervention here, which won't leave shareholders with very much. And you can look at all the other ones. PACW is another one I've been watching. It's down significantly again here today. So despite the market holding up fairly well overall, but that's because of tech stocks. You can see if you really look under the hood, and I talk about this on PreMarket Prep as well. A lot of times, you can see the indexes, but the S&P is skewed because it's obviously so heavy Apple, Microsoft, Google's, and the big tech titans, that when those are holding up, the market doesn't seem like it's weak. But if you go to the IWM, you kind of see a different story. It's down substantially in the last couple of weeks here as well. More broad-based, more small cap weighted, which obviously if we get into credit concerns where banks maybe aren't lending as freely as they were prior to this banking crisis, smaller companies are going to struggle. That's probably why the IWM is weak as well. So taking it back to your TLT trade, if you think that tougher times are ahead, then usually capital will flee into safety, and TLT is safe. And also, if you think tougher times are ahead, it means that the Fed is probably going to be easing sooner than later, which would also be good for TLT. So I personally like your trade. I do think the TLT could continue higher. We've had a recent dip here. I think you are early. I think I'm early as well. So I can't tell you the date of the next bank failure, but I think there's more to come. And I think if you stick with that trade, I think you're going to be okay.
Okay, that's good to hear from a pro. Get some live analysis on the trade. So speaking of banks, I want to talk about banks a little bit as well as SVB. But so we saw with Silicon Valley Bank, shareholders got wiped out, and banks are trading at about 1 time tangible book value. We know European banks trade at like 0.8, 0.5 tangible book value. So do you think banks are expensive now, knowing the fact that there's going to be no bailout for the shareholders, so they're going to get wiped out?
I
Would you
don't
own
think
banks?
I wouldn't. I don't know if they're necessarily expensive, but the unknown of how far this banking crisis, and it is a crisis in the regional bank, spreads is concerning. And that makes me not want to own banks. And I learned the hard way after the financial crisis that banks are not fun to own. I had Citigroup in my long-term portfolio. I watched it go from $45 to $5. And I eventually did sell at $5 for a huge loss in my long-term portfolio during the financial crisis. And I was trading great back then, but I had some, long-term core holdings. And I was like, you watch a stock fall 90%, and Citibank, one of the biggest banks in the world, still is. And, people say, well, why didn't you just hold on? It came back, but they don't realize it never came back. Citigroup had a 10-for-1 reverse split. The all-time high on Citigroup, which would be equivalent, was $500. So if we go today, it's still trading. If we take that 10-for-1 reverse split back, it's still trading at $4.46. So here you are, 13 years after the financial crisis, and Citigroup never came back. JP Morgan came back. They didn't have to dilute themselves. But once dilution gets involved, these shares typically don't come back. AIG never came back. Citigroup never came back. Certain stocks, obviously, like Lehman Brothers, went off the boards. Bear Stearns went out at $10. So a lot of these stocks never did come back. So I've just learned that banks, can be tough investments, and they are susceptible to, these issues where if you get the consumer, if you get their customers all scared at once and they demand their money all at once, they don't have it on demand. They're lending long, borrowing short. They are all susceptible to bank runs, so it's not just regional banks. Obviously, some majors have more capital, so they have more cushion for it. But all banks are designed to not be able to give out 100% of the money that they've borrowed at a given time. So that's all really bank run is. So I just don't invest in banks at all. I trade them. I usually trade them market neutral, where I might be long one, short one. But I typically don't invest in banks after that. So you can look and you can say, yeah, they probably are cheap from a valuation perspective, but they've been very bad investments for a long time. There are some, like JP Morgan, which are best of breed. If I was to buy a bank, would probably go to the best of breed with the JP Morgans. But when you see stocks like Citigroup that have gone nowhere for 13 years, it's hard to think that this is where I want to invest my money.
Yeah, it's very interesting you mentioned that. A lot of people think banks is actually a very tough business, right? Because they're in the business of really a symmetric risk to reward. They give you a loan for 5%. Worst case scenario, they don't get paid. Best case scenario, they get 5%. So
yeah,
it's a tough business, and yeah, they've been a crappy things to own for now about 15 years.
yeah.
I totally agree with you. I think there's just too much risk involved with them. In our community, we look at FRC and the premium on this stock. You can make 15% a week just selling some out of the money puts, but it's really like lottery. You don't know what's going to happen. It's very risky.
And there's risk. I mean, it could go under next week. So you go and grab that 15% this week, but if the thing gets government intervention, you lose 100%. So
You lose 100%.
yeah, that works well if you can get 7 weeks. I don't know if we got 7 weeks left in First Republic. I guess maybe I did my math. No, about that. 7 weeks. You need, if you're getting 15% a week, to really recoup your money. And then be completely playing with the house's money. So maybe you do get it, but I mean, just this chart, it just doesn't look that healthy to me. So, and again, we're not too far from the lows. The low of the whole move is $11.52. We're trading at $12.85 here right now. We had a good run yesterday, 1638. People think we're out of the woods, but we're far from out of the woods. And here's the stock retesting the lows. It's just too scary. So yeah, the risk reward is like, it's nice to think, oh, I can make 15% a week selling puts, but it's not going to be nice if this becomes the next Silicon Valley Bank.
Oh, absolutely. Yeah, exactly. That's exactly what I've been telling people as well. It seems very juicy, but there's always a catch.
A lot of risk.
Catch is, a lot of risk. Kind of shifting gears a little bit. Let's still talk on the topic of the bank. I was furious when we came up with that unlimited insurance for the SVB and just making depositors whole. I just felt like we should have gone the normal route of getting 80 cents, 75 cents, 80 cents on a dollar, and I feel like it was a little maybe preferential treatment because it was really one client and it was the VCs of the Silicon Valley Bank, and I felt like they manufactured a bank run on Twitter from David Sachs to Jason Calacanis. So what are your thoughts on this? How do you think we handle it? How do you think the Fed handle it? And what are the implications of basically unlimited insurance now for depositors?
Yeah, and they haven't confirmed whether they will do that. Well, obviously, we had a mixed message from Yellen on this last week, where she was saying that they haven't talked about giving unlimited insurance here, and then the next day she was saying, "Oh yeah, we are talking about it." So we still have mixed messages, and we don't have confirmation whether they're just going to insure all depositors or not. Very mixed. I understand that it's very difficult when, and obviously there's a lot of people who have their money with Silicon Valley Bank out in California, and there could be some small companies that are doing very well, and then all of a sudden they can't pay their bills because his money is all locked up. So it's not really fair to those customers that, yeah, your business is doing well, but you can't pay any of your bills because your bank failed. So I get it. I get that, I feel for those people. There was somebody almost crying on CNBC the next day. He's like, I've got employees, I've got all this stuff. I need to buy product. I can't do anything because I can't touch any of our money. So I get that, bailing out those people. I get it. But at the same time, I do see the concerns that you're talking about too, is it's a slippery slope. Where does it stop? Like, if all of a sudden, yeah, one bank, two bank, fine. If we get a dozen banks failing, then that's eventually going to be on the taxpayer here to bail them out. So banks can take, all this risk on, and then the taxpayer bails them out. It doesn't sound that good for the taxpayer. So I see both sides of this story. I hope there's no more bank failures. I hope we don't have to cross that bridge, but it is a slippery slope, and that's my concern as well.
It's so interesting that you mentioned Citigroup as well, and I also find it very interesting that we didn't want to use the word bailout this time around. It's not a bailout because shareholders got wiped out, but the truth of the matter is, as you mentioned, shareholders also pretty much got wiped out in 2008. Citi never recovered, so it's always, the bailout has always been about the depositors, and some of these depositors are the big guns, really. So I mean, I think it was a bailout, whether we like to not
It
call
was. And they don't like to use that word, but it really was a bailout. So, yeah. So I know. Again, it was a much different situation in 2007, 2008, where those were real bailouts, where we had to throw good money at the problem, hoping to stem the tide, and they did. But the problem is really, and again, let's just get to the root of all the problems. It's just the printing press has been the root of all the problems for the last 15 years. Is that we've just printed more money. You can see the U.S. deficit, where is it now? $30 trillion or whatever. I haven't looked at that U.S. debt clock lately, but the debt here is just unsustainable in the long run. Like, even servicing the interest on it is going to become difficult. But it's not just the government; it's the individual as well has debt. So I mean, the consumer themselves have really been built on debt for the last 20 years. If we think back to like 40 years ago, when you had to buy a home, you needed 25% down to buy a home. You saved, and then you eventually bought a small home. You saved, and then you eventually got to buy a new car because you've saved money over the course of your working career. Now people want stuff now, so they're like, give it to me now and I'll pay for it later. And that's just the mindset of the consumer that has changed, and the government has embraced that mindset as well, and continue to print money and throw money at all problems here. And at the end, the problem is everybody's just in a lot more debt. So we keep kicking the can down the road to our children, or to potentially even our grandchildren here, to service all these bills, which I don't even know how they're going to eventually service it if it continues to go up like this. So everybody's got, huge spending habits now, this YOLO thoughts, you only live once. I want to spend, now, and, I'll worry about paying for it later. Even taking it to the current, issue. And, I can tell, I'm Canadian. I've lived in Canada my whole life. And just recently looking, at, mortgages and the mortgage books in Ontario here. And interesting, a few people on Twitter, that are well followed in the Canadian markets, talking about what the banks are doing now. So they've now, typically in Ontario, it was usually 25-year amortizations on your homes. So, but with interest rates rising as quickly as they could. I'm sure you've had some customers coming in that were on variable rates. And I know in the US, a lot of people have fixed rates. In Ontario, a lot of people have variable rates, and they usually go 5 years max. So if you're coming due, you're going to go into a variable rate that maybe you were at 2 or 3%. You're going to be at 6 or 7%. Hard to service those payments going forward. So what they've done, the banks, to accommodate the consumer and allow them to continue to spend the way that they have, is they are extending those amortizations out to 35 years or to
Yeah.
40 years or to 45 years from the norm 25 years. So if you look, when you take an amortization and say you had a rate of 2.5%, you take that rate to 6%. Well, if you're doing 25 years, if you extend it out to 35 years, the payment becomes back to the same. So basically, the consumer isn't strapped for cash anymore, except they're going to pay their house off 10 or 20 years later now. So, I mean, this is how the banks are dealing with the problem of people not being able to service the increase in their interest payments from their mortgages, is that they've just extended the amortization on their loans, and that's allowed them to bring their payments back down to where they were prior to them raising rates. So it's basically undoing what the central banks are trying to do. Central banks are trying to slow demand. The banks just found an easy way to undo that by extending the amortizations, and then people still have lots of money to spend. Same thing on car loans. Typically 5 years, they're doing 10 years on some of these loans now. So I mean, by the time you pay off your car 10 years, the car is worthless. So again, it's just people have, changed their mindset that they want to spend money, and the banks are finding a way to do it. But you can see the problems that this can lead to. And in the US, obviously, we've got a lot of problems with these inverted mortgage books. And, obviously, if you're watching any type of media, you know what that's about. But, this is an issue here that is eventually going to have to be dealt with.
Yeah, absolutely. So I want to take it to two places. This is very interesting because same thing of kind of rolling the debt over and just increasing the amortization. Same thing's been happening with commercial mortgage books, right? A lot of them are bullet payment. They're interest only, and since the 80s to 90s, the rates have been lower. 90s to 2000, rates have been lower. Since the rate has constantly been coming down, a lot of these commercial books, these loans have been able to just roll over these bullet payments and roll it over to another 5 years, to another 5 years. And now, for the first time, we're seeing the capital market rates, the 10 years, actually higher than it was 10 years ago. So now it's problematic, and a lot of people are talking about the commercial mortgages. Do you have any opinion on the just the whole commercial real estate?
Yeah, I mean, same thing. They're going to try to find a way to accommodate the customer here.
Yeah.
So, I mean, you're paying. So if rates and again, this is going to be an issue going forward. If rates stay, so let's just take a step back and just put out scenario analysis.
Yeah.
Two scenarios really here at this point in time. Rates are not probably going much higher because we can see the problems it's starting to create. So the Fed is going to have a tough time to continue to raise rates. Could we go another quarter maybe? But these 100 basis point hikes, even if inflation starts to get out of hand, are going to be hard to sustain because you can see what's happening behind the scenes, struggling banks, struggling consumers in different ways. And again, to your point, when some of these corporate, some of these other businesses, maybe their loans are coming due here and they've got to roll into another loan, those rates are going to be higher. So it's going to be hard to continue to sustain those higher payments there. So, I mean, at a certain point in time, the Fed probably is handcuffed here, meaning that they're going to have difficulty probably raising rates further. So the best they can do is just hope that inflation starts to come in, that maybe some of this other stuff deals with the problem. And it probably does. I mean, as people start to see, as my money saved at the bank, they're probably not going to buy a new car. So, I mean, it can slow it down to a certain extent, and maybe that is what actually eventually takes us into the recession. But when you look at all these banks and you look at the situation they're currently in, it's going to be hard for the Fed to continue to raise rates. So that scenario, the two scenarios I really see are rates kind of stay elevated for the foreseeable future to try to fight off inflation, or we have a worse situation happen. We get thrown into a recession, we have a more banking crisis, and then the Fed has to start rapidly lowering rates. So and if that happens, then you can get into a situation of stagflation, which is not going to be fun for anyone, where you have still rising prices, but the consumer and slowing demand. And I think that's probably the worst case scenario. So I think the best case scenario is the banks stabilize, rates, stay probably at these levels for a little while here, as long as they can, and bring inflation in check, and then eventually they start to lower. But either way, I think this, path of like higher rates is going to stop suddenly here, and I think it's going to be sooner than later. So I'm leaning on more of the side of the central bank slowing rate rises or potentially even pivoting.
Yeah, this is very. Speaking of inflation, because you mentioned it, have you seen inflation? I mean, from the inflation data, obviously, but just personally inflation coming down. Because for us, with trading terminal and the businesses we run, the sticky part of inflation, which is the service inflation, we have absolutely not seen a single improvement. If
No.
anything, our vendors are really using that 13% year over year inflation figure and just jacking up prices. So I think the base case is probably that stagflation that you mentioned. What are you seeing?
No, I don't see improvement here, and we can see it in the CPI. Like maybe it's ticked down, and we're kicking around 6% here now. So it's gotten better from where the 9. But we know when we look at the CPI data, the way they calculate it is much different than the way they calculated it 20 years ago. So even when we were looking up near 9%, the real number was 14 or 15. We know it's 5 or 6 points higher just because of the way they calculate things now. They don't put certain things that are really inflationary in there. They take out this. They don't even look at housing prices. They look at this rent equivalent. The way they
Yeah,
do things are just different. So when you just take the CPI at face value and say this is it, it's not really what's out there. And I was just tweeting out, recently about bread prices. You're seeing like
yeah,
just basic groceries. Where I used to buy cottage cheese and it was $3.99 for a container. That same container a year and a half later is now $6.99. The
yeah,
juice that I bought for my morning smoothie, Oasis, was $1.29 or $1.19 for a jug. It's $2.19. So I
yeah,
mean, some things have gone up substantially, and I just went through a house build, which was just insane to go through. Worst timing, through COVID trying to build a house. But
yeah,
same thing. I mean, we were going through our drywallers, and the drywallers had quoted us out, and then they're coming in here and they're jacking the price up 25%. And my builder's like, well, why are you jacking the price up 25% here? And he says because everybody else is.
yeah,
That's what his reasoning was. Everybody else is. So if everybody's raising prices, I'm raising prices too. And the mindset has changed. And the consumer expects now to go to the store and see higher prices. We never expected that before. So now because they expect it, they're more accepting of it. So now it's acceptable to start, raising prices. And it's a slippery slope right there too. The consumer mindset has changed to just expect to pay more. So it's now acceptable to raise prices even when you don't need to raise prices. So, and wage inflation has always been sticky because nobody's taken a wage cut. And, if you're
yeah,
seeing prices go up 10% or 15%, on the stuff that you're consuming year over year, you're going to go to your employer and say, I need a 10 or 15% raise. And you know what? Then they have to give it to you. And because they have to raise prices, they have to pay you more, then they have to raise prices in turn. And how do you stop that vicious cycle? That's how
yeah,
you get into a situation of, in smaller countries, hyperinflation. We're a long ways away from that, but that's how the cycle begins. So I think we're a long ways away from getting ahead of the inflation problem here. But right now, the banking crisis here is taking precedence over the inflation concerns. So there's lots of reasons not to invest in the stock market at this point in time, though. We can talk about, inflation and the Fed still not being on top of it. But the other thing is the banking crisis. But then again, if you think, that we're going to have to start eventually lowering rates, maybe that elevates the tech stocks. So lots of balls to juggle here. I don't think anybody has a crystal ball to tell us exactly where we're going, but all we can see is there's a lot of unquantifiable risk here, which keeps me wanting to have some cash.
yeah. So that's a great segue to kind of my next question. And you've tweeted about this. I think we have a screenshot of your tweet. You talked about someone asking. You talked about there's just so much risk that is not yet. We got it on the screen. Unquantifiable risk here. Hard to invest in this market. And you kind of talk about your edge really being on the information side and processing the information and the
Yeah.
information flow. Do you see a risk that is not being priced in properly right now in the market?
No, I think
As
the banking crisis is not being priced in, at least in the S&P, with the S&P as elevated as it is. I think that this market has priced in that we are not going to see any more bank failures. If we see, it's going to be a small one. It's not pricing in what I'm seeing in the majors. Not that we're going to have failures in the majors, but Bank of America, down from $34 just a week and a half ago, 2 weeks ago, down to 26. It is up to 28 in the last couple of days, getting a little bit of lift. But you're starting to see the major banks start to take a hit here now too. And then overseas, we know the Credit Suisse situation isn't great. Deutsche Bank situation isn't good. But those haven't been good for a long time. But yeah, there's always, this market, and people, firmly believe, if you go to your economists or your textbooks, that the market is efficient and it prices out all information looking ahead 6 months, 6 to 9 months. That is a load of crap, because I've traded professionally for 23 years. If the market was perfectly efficient, I wouldn't be able to extract alpha out from the market on a daily basis. So the market is not efficient. The market is very inefficient. It's made up of opinion. It's made up of irrational exuberance. When you were talking about Greenspan back in 1996, it's made up of FOMO. It's made up of fear. It's made up of a lot of different things. And it's honestly made up of people who are making trading and investing decisions on very little information, called those uninformed participants. So there is a lot of uninformed participants that are actively trading this market. And we're all uninformed to a certain extent. But my edge as a trader is try to be more informed than the other person on the other side of my trade. So, this is why I've always said you need information if you're going to be a professional trader. Even if you're going to be an investor, it's good to have good information. Maybe you want to look at fundamentals, maybe you want to look at technicals. I try to look at everything. I try to look at the macro picture, top-down approach. What do I think about the overall economy, which will then bring me into, do I want to be long or short stocks, which will then bring me into, maybe into some of my individual trading strategies. But information is always the edge, and and people don't want to pay for information. They want to just go on Twitter. They want to start like your typical traders, and obviously at Bright Trading, we've seen a lot of people come in. But I've seen a lot of retail traders just being with Benzinga for the last 10 years that want to come in with a $25,000 account or even less, and they want to make $50,000 to $100,000 a year on that. They don't want to pay for anything. I pay for information. The Benzinga Pro. I have scanners that I pay for, other news sources. Trade Ideas is another one that I use. You can't be afraid to spend money to make money. So I know we kind of went on a little bit of tangent here, but bringing it back, information, the publicly available information that's out there is critical to get in. You've got to be on those SEC filings. Warren Buffett, buying more Oxy is probably a bullish catalyst for that stock, at least in the short term. Just understanding that all of this other information makes up the stock price. It's not just made up by looking at a chart.
That's amazing. No, that was actually a great explanation, and kind of, since you started talking about some of the newer traders and retail traders, because that's the majority of our viewership. You talk about your framework, which is the top down, and of course, you have your CFA and your background, and it's probably a lot easier for you. For someone who's just starting out, how would you recommend they should start kind of defining their own framework? What's some of the steps that you would give as kind of an advice per se?
Well, it's a great question, and obviously I think there's not just like, it can't just give you the prescription to make a trader who's just starting to be a good trader in 6 months. One is time, it's screen time. Learning yourself. Start small. This is how I started Bright Trading. Let's take myself back to 1999. When I first started, it's 24 years ago. But I actually started trading retail in 1997, 1998. So I kind of thought I knew it all. And it's funny, if you look at the markets back in 1997, 1998, we were kind of going straight up until we had the tech bubble burst in March of 2000. So when I joined, Bright Trading in 1999, it was May of 1999, I thought I knew it all. I was coming in here, I make money on all my trades, I'm good. And then, quickly you realize, because I was sitting with a lot of traders that come from the floor, a lot of traders with different experience, that I could draw information from and learn from, that I quickly learned that I didn't know as much as I thought I did. So I think you've got to come in and realize that you don't know anything. And none of us know everything, but when you first start, you don't know anything. So you've got to, understand basic, mechanics of using, level 2 screens, understanding what you're seeing, understanding, what the book looks like, understanding, what, the time and sales look like, understanding, what makes up those charts. Order flow makes up those charts. So, slowly just, nibbling your toe in, get your feet wet. I always say start with 100 shares. If you're trading a $20 stock, you buy 100 shares of it, it's $2,000. Or the nice thing is, I used to say that back in the day because you had minimum commissions. Now you come in commission free, so I guess you can start with like 1 share or 2 shares or 5 shares. Really small. getting your feet wet. So as you learn, and expect to lose money always in your first year. In my first 6 months, I lost money overall, and then eventually after 6 months, I started to make money, and then I've made money ever since for the last 23 years, at least in my trading account. So I think you just got to have the expectations that I am going to struggle for the first 6 months to a year. I need to learn. I need to be able to take in as much information, learn from other traders as I can. I mean, whether it be watching podcasts like yours already, watching the pre-market prep show, just taking in information. And I didn't have all those sources back when I started. I had my Bright Trading Room, which had some very good traders in there, so that was helpful. But we didn't have social media. We didn't have all these, different people we could learn from. There's lots of free information, but don't be afraid to pay for information too. I mean, people
Yeah.
are always afraid to spend money. Imagine starting a business and saying, I'm going to spend zero, but I expect to make $100,000 a year. People would say, you're nuts. There's no way you can spend zero and make $100,000 a year. You have to spend money on your education. You have to spend money on yourself. You have to be able to willing to, yes, free content is great, but, sometimes you've got to pay for really good content. So, and don't be afraid to, pay. And obviously, I think you do need a good news source, whether that be Benzinga Pro. Obviously, I'm promoting Benzinga because I work with Benzinga on the pre-market prep show. But there's other, news sources too, whatever, But I think you need some type of, regular information. Just trying to go to Twitter, what's the news? You always see people asking on Twitter, what's the news? Well, subscribe to some type of news source, and you might know the news. CNBC is not good enough to just have your CNBC screen on. What's breaking on CNBC probably broke 20 minutes ago somewhere else. So I mean, it's not like CNBC. They're just doing other things. They're doing interviews. It's not their full focus on just giving you breaking news all the time. They're trying to put together programs and do different things. So I think you need a regular news source. So I would say to the newbie, take your time, start small, trade, and don't be afraid to pay for education and information.
Yeah, wow, well said. Yeah, absolutely. I mean, speaking of Benzinga, so it's phenomenal. I think Bearable Traders, the trading terminal, our community, we've had partnership with Benzinga, I think, for over 4 or 5 years now. They're phenomenal, and they're the leader in the category when it comes to news and information. And you're absolutely right. Just the screen time. Just put in the time in. I got one more market structure question that I have that I would love to
Sure.
know your opinion. The 0 days to expiry, it's making a lot of buzz. I personally, like, I'm looking at it, and I know the volume is a lot. I don't see a per se a systematic risk, but I'm hearing on Twitter a lot of people are saying, oh, this is going to be the next volatility crash in the market, is 0 days to expiry, dampening volatility. What are your thoughts on it? Have you looked at them, or do you think it's just a nothing burger for now?
I don't trade options anymore. I traded options in the early 2000s, and I stick with pure equities here right now. But I do have the options experience from back in the day that I can draw from. There, it does dampen volatility when you get more products that come out, because obviously a market maker is a jockey of stocks against those open option positions. So when somebody's making a bet one way, the market maker is hedging themselves the other way. So, I mean, that can dampen volatility. It can, push prices in certain directions depending on what the open interest is on those. Most of these products are designed to just extract premium from uninformed retail investors. And it's sad. Like, I mean, as they continue to create more and more products, and it's not just 0 days to expire, it's so many different products. These structured products, triple long, triple short, bet on this, bet on that. It's all just become like more like a casino as opposed to investing. And people don't understand how some of these products are structured, is that there's risk in just owning these things long term. A lot of these triple levered funds are designed for day traders. They're designed for 1 day holding periods, and you hold some of these products for longer periods. Those products tend to decay over time because of the way they're structured. So, and I mean, this is what we've gotten into, is that people are investing in products that are designed for trading. There's so many different things, and take it even to like, what's with like all of a sudden we've got to have Tesla bull
Yeah,
1.5 times shares. I mean, we're having derivatives of traded ETFs off of derivatives of single stocks. I mean,
yeah,
there's so many different things that I don't know the reasoning for creating all these little products. Again, maybe the inverse funds are created because some people can't short stocks, so they want to be able to give you exposure. But if you can't short stocks in your emergent account, maybe you shouldn't be buying triple levered short funds, which obviously are just another way to get around the rules.
yeah,
So I think there's just so many different products that are being created that actually are a detriment to the retail investor, despite being marketed to the retail investors. So you got to be very careful with some of these products.
Yeah, absolutely. My rule of thumb is always just know the business and know what kind of business they're in. A lot of these ETFs are in the business of collecting fees, so really
Yes.
understand uh, the dynamic and the structures of what you're buying. Uh, Next 6 months, if you had to pick one, cash, bonds, equities, what would you
Bonds,
pick?
100% bonds. I
Bonds?
like the bonds because I think we're going to go into an environment. Again, I'd stay away from corporates, but government bonds, or at least, high, if you're going to corporates, don't go into like the little junk stuff. Stick with commercial grade. I do think bonds are going to do well for the simple reason is that I believe that the interest rate hiking cycle is nearing its peak. And in a decreasing interest rate environment, bonds do very well. Also, if you get into a spot where you're getting into, more bank failures, government bonds are going to do well because it's a flight to safety. So I like government bonds here. Actually, I like your TLT trade. I can see the pullback that you're looking at here, and I can see that there's an opportunity here. I do think the TLT could end up being higher. It's something you don't want to own, and just bring it back to basics. I mean, look at the TLT, and it was trading $160 when the Fed was warning us. This was the end of 2020. And they were, hey, we're going to go into and we're going to start raising rates in 2021. And look what it did. It gets cut down, cut down, cut down, all because obviously rate increases. And nobody predicted that they were going to increase rates as fast and as furiously as they did. But they were telling us they're going into a hiking cycle. Now you go and you're kind of getting the feel that the hiking cycle is over. We're not necessarily at a pivot here yet, but if we are thinking about a pivot, and I think a pivot's coming sooner than a lot of people think, that will be good for bonds. So I like bonds here. I don't want to own any stocks because I don't know the uncertainty. I don't think of the risk here. And stocks themselves are not cheap at 19 to 20 times earnings. Yes, on the IWM, it's a little bit lower, but there's a lot more risk there as well. So, and cash is okay, but again, yields are starting to come down on cash too. I was tying up some cash at above 5% a few weeks ago. Now you're going to struggle to get 4.5 if you're going out. So the
Yeah.
cash yields are coming down. So I like bonds. I think the back half of 2022 or 2023 is going to be a better time for equities because I think we're going to get, the stock market coming down maybe to the tune of maybe to test the October lows at a minimum. So say we're down another 10 or 15% from where we are now. I think that gives us an opportunity to maybe start getting back into some solid companies at reasonable valuations. But right now, I like bonds.
Yeah, love it. I think right around October lows at 220 earning estimate, I think we'll be at around 16 multiple, which is a lot more reasonable than 18 and a half that it is trading at right now.
Yeah.
Yeah,
I mean, a lot
so
of times in these, in these bear markets, we bottomed out at 12, 11, 12, 13. So, we're saying we're in a bear market, but we're 18, 19 times earnings. It doesn't feel like we're in a bear market. We're
not
19
something.
times on the S&P, especially with elevated earnings. So, if that E starts coming down, that P is going to start to climb on you and be like, whoa. So I just think stocks here are priced to perfection. They're priced that everything is going to be okay. We're going to get past the banking crisis. Fed's going to just magically lower rates and inflation's going to go away. And I think that's wishful thinking.
Yeah, I 1000% agree with you. Yeah, that's why I'm more towards bonds as well, and just waiting for a little cheaper valuation here. As Warren Buffett used to say, the price is what you pay, but value is really what you get, right? So,
Oh, that's a
uh,
great quote.
Dennis, anything on your end that is happening from either the pre-market prep, anything you would like to talk about as we're coming to the end of this interview?
We're still working on some other things. Joel's done some great stuff at PreMarketPrep.com as well. We're starting to work on, looking towards doing, maybe, some more extended coverage of the markets here. I've always said, I've been trading, for 24 years, and I'm 46 years old here now. Another few years, I probably don't want to be grinding out 100, 200, 300 trades a day. Maybe I want to slow it down a bit and talk more. So I think it's natural progression for myself to probably teach more as I continue to, right now I'm still full in, the trading mode where I just, basically do a 1 hour teaching show. We've done some stuff on Saturdays or, some podcasts on the side, but I think eventually we will be launching some more educational products where I'm doing some more teaching and maybe some extended coverage, on a probably a paid product. I wish I could do everything for free. We do pre-market prep for free. And we get some great trading ideas from the great chat that we have there. But obviously, we've got some good sponsors there too, which help to pay for the show itself. But at a certain point in time, you've got to look, and if I'm going to trade less, then I probably have to subsidize that income somehow. So we may, on a launch of another product, we may actually charge for it. But we're a little ways away from that. But we're talking about towards the back half of 2023, maybe launching a paid product where you get more of me and more of Joel, and probably more of Benzinga as well.
Absolutely, that would be amazing, and I can't wait to have you back on the show, of course, if you allow us, when the product gets launched. I mean it, like, genuinely, it's been a masterclass for me. I've been following you, been learning a lot from you, and you're one of the few people that actually post your returns on Twitter, and
I just started doing that, so
yeah,
I wasn't able to do that when I was with Bright Trading
right,
because there's real, and I was under the prop guidance of Bright Trading, and I wasn't able to actually do as much discussion. But now that I've switched to my own firm, I can actually post monthly. I've been posting out my results of my trading, my trading account, and my trading account. So just if you're just following me or just learning about me, so I have two accounts. I have my long-term investing account, and then I have my short-term day trading or overnight account. And the day trading overnight account, I start trading basically around 3 p.m. usually, where I'm taking on positions for the close. I'm taking on, overnight positions. I trade after hours where I'm, taking advantage, of maybe breaking market information, maybe trading some earnings, maybe trading some peers, different types of strategies. I trade pre-market as well. And then typically I close out, and every single day I close out all of my day trading and overnight positions by 10 a.m. Eastern. So I go back to 100% cash at 10 a.m. Eastern, and then I reevaluate. Sometimes I have some swing trades on, but almost 99.9% of the time, I'm 100% cash once I go to, once it gets to 10 a.m. Eastern. And then in the middle of the day, I'm reevaluating, analyzing. It's hard to trade. I've always said 11 to 2 is toxic hours for day
yeah,
traders. People will try to make money during these hours. I think it's a mistake. There's the efficiency of the high frequency trading, of the algorithms that are running during that day, make it very, very hard to gain an edge in the middle of the trading day. There's good edges at the open, good edges at the close, good edges in the pre-market, good edges after hours, middle of the day, toxic hours. Very hard for a discretionary trader to beat the bot. So I avoid that middle of the day, that 10:30 to like 2:30 hours. I typically do not trade in. I've always got long-term positions on. I range in my cash holdings. Sometimes down as low as 10 or 15%. And up to, like, in this case, I'm upwards of 65% cash here right now in my long-term account, for the simple reason I think there's more trouble ahead. But the day trading, I usually trade at market neutral. So I'm equal longs, equal shorts, trying to just, sometimes I'll skew it a bit depending on what I feel like. But, just taking advantage of little market edges, little market inefficiencies. That's how I trade.
that's amazing. Yeah, well, congratulations really on those returns, and I really think there is a market for you teaching. I personally, I'll be your first client.
Oh, thank you.
Absolutely, yeah, 1,000%, and can't wait to continue to learn from you. Well, thank you so much for coming on the show. Really appreciate it. Our time's almost done, so really
Okay.
appreciate it. We covered a lot of stuff, and again, thanks for coming on.
Artie, thank you so much for having me. It was a pleasure. Enjoy and good luck with everyone with their trading. And if you want to see more of us, we're on the Benzinga PreMarket Prep Show, 8 to 9 a.m. Eastern, Monday through Friday.
All right, awesome. Thank you.
Thanks, Artie.